Hello, I'm Carey, Director of Research for Baird's Private Wealth Management Division. Today, I'm joined by Ryan Grabinski, Managing Director in Investment Strategy for our partner firm, Strategas. Welcome, Ryan.
Thanks for having me.
Excellent. We've asked Ryan here today to give us some insights on what Strategas is currently thinking about the markets today. To do that, we want to walk through our market gauge. We've built this market gauge in conjunction with Strategas to give people sort of a point in time look at what Strategas is thinking about the markets. On a monthly basis, Strategas looks at 16 different building blocks that can be either positive or negative drivers to the market. So Ryan, right now, the market gauge is pointing to a neutral stance, but you comment that you're mildly positive on the markets right now. Can you give us a little bit of insight on what tends you towards that direction?
Yeah, absolutely. So right now there's a few signs that sort of keep us constructive on the markets. Really, the first is related to the Fed. At this stage of the recovery, we see no reason to really take the Fed for. We're taking the Fed at their word when they say that they're going to be easy for the foreseeable future. One of the things that we're watching with regards to this is actually the Fed Fund futures interest rates. And if we look at what the market is thinking about here, they're really not expecting a rate hike till the end of 2022 or early 2023. As far as the technical picture goes, the technical picture is also extremely supportive at this point, with more than 90% of stocks above their 200-day moving average. I was actually conversing with one of the analysts on our technical team earlier this morning, and he told me that it was the highest reading in 40 years. If you add on top of that the strong earnings recovery that we're seeing and the strong economics that we're seeing, it gives us some comfort about the state of the markets at this point.
Excellent. So are there any things that you're looking at right now? What would change that perspective?
I think there's really two things that we're focused on that could potentially change our perspective. And the first is with regards to Washington policy and everything that's going on with the potential for increases in corporate tax rates. Obviously we've gotten some of the details with regards to the plan, and we know that there's an expectation that the corporate tax rate will increase from 21 to 28%. But ultimately, it's going to come down to the details here. Our sense is that the burden of the tax increase will not be equal across companies and will ultimately be heavier on multinationals, and they're going to experience a larger tax burden. The other thing that we're watching here is really the U.S. dollar. Over the last month, it's weakened pretty significantly. I think with regards to the dollar, we're really concerned that the more that it weakens, the more potential for inflation that we could potentially see. Essentially, as the dollar falls, the dollar-denominated prices of commodities like oil tend to rise, which could lead to ultimately higher prices for consumers. On the positive side, though, a weaker dollar is beneficial to those companies that do export goods, so they could potentially see higher revenue growth from the weaker dollar.
Okay, excellent. Well, Ryan, we really appreciate your insights and the additional color you've provided today on the market gauge.
Okay, absolutely. I'm happy to do it anytime. Anytime you want to hear more about what we're thinking, I'm happy to help out.
Excellent. Thanks again. To our audience, as always, if you want further information, we suggest that you reach out to your Baird financial advisor.